Hi everyone, my name is Alex. I'm the founder of Nauma, a personal finance platform that helps people in tech make better financial decisions and navigate complexities of the financial system. People create their financial plans, organize their investments, and do tax planning using our platform. Our users save millions of dollars by making more informed decisions and get clarity about their finances they didn't have before. Today, I will talk about how you can make a decision whether to buy a house or not. It's a dream for many people, but is it a good financial decision for your family? To demonstrate this process, we'll use one family as an example. They are in their late 40s and they have 2 kids and live in San Francisco Bay Area. They work in tech and plan to retire in the next 10 years. We already built a projection for this family, so you can see their status here. I wanted to say that this family is financially in a good spot. They already have a net worth of $5.5 million, which puts them in top 1% of the families in the United States by the net worth for their age group. They have assets in taxable, tax-deferred, and tax-free accounts, and also real estate property. They live in a house in Santa Clara, which they bought about 9 years ago for $1.3 million. And today its price is $2.2 million. They pay property tax, annual insurance, and have annual maintenance costs associated with this property. They have 2 cars in their households, and the house has mortgage. They pay 2.65% fixed rate on their mortgage, and they have almost $900,000. That's their current outstanding balance. As I mentioned before, they work in tech, and plan to work for another 10 years. This is long-term planning tool, so we try to keep expenses high level, and we try to separate only things that have a different timeline. For instance, living expenses will be always around, but mortgage or maybe a sports team for kids, it will stop at some point, and we separate these things automatically for them. We also already have done some estimates for the income taxes because we know their income, their current income, right? And we know that they pay $258,000 in taxes in total. This family lives in California, and federal income, you can see that state tax is pretty high for them. Now, let's take a look at their default financial projection. So for us, in order to make important decisions, we need to know not only our current net worth and our income, but also how these things will change over time. That will help us make better financial decisions. So what is financial projection is that we take current and future income and expenses that the family will have and put it on the timeline. And then we can see how it will affect their net worth over time. And then using this data, we can actually make better decisions and understand what is the impact of one or another expense that the family will have. So this family is considering buying a house in 4 years from now. It's going to be their vacation home, winter home that they will buy in 2029 and own for 10 years and sell after that. So for that, they built another projection, which they named as Buy Winter House. And you can see that there are some new items that were added here. So first of all, there's a live event called Buy and Own Winter Home. And you can see that their financial projection has changed a little bit, right? There are new items on that. And let's take a look what's inside of that. So we'll click inside of this live event, and then we can see all income and expenses associated with that. So first of all, they would like to buy a house that is worth $2 million in today's dollars, and it will have a property tax around $22,000, which is almost 1%, annual insurance, and the family expects that they will have also maintenance costs associated with this house, which is something that many families actually miss, but it's an important expense. In order to buy this house, the family will take mortgage for $1.5 million. And they expect that the mortgage at the time is going to be about 6%. They are going to take fixed rate. They don't want to use adjustable rate loans, so they will take fixed rate loan, and they will take it for 30 years. But they are going to pay it off early because they're going to sell the house. And that means that their monthly payment is going to be around $9,000 for this mortgage. There are also other income and expenses and transactions associated with this house. Let's go and look one by one what's included there. So first one is, of course, buying the house. It's $2 million that's going to be outstanding expense that they will do in 2029. They will be also buying closing costs associated with this transaction. So it includes loan origination fees, title insurance, escrow fees, appraisal, and many other things listed here. And total is going to be around $40,000. They will pay insurance, maintenance cost, mortgage is going to be $107,000 a year, and property taxes. When they sell the house in 2039, they will pay closing costs, which is between 6 and 8% on the home price at the time. The family expects that they will sell the house for $2.6 million 10 years from now. And that will result in two transactions. First, when they sell, they will need to repay their loan and close the loan early. It's going to be $1.2 million. But also they will get principal and gains. We intentionally separate this transaction on two so we could specify the income type. For principal, we set tax exempt, and for home sale, we will specify that it's a capital gain income because the family currently doesn't plan to buy another house instead. So that shows us now we can look at their cash flow projections and how their income expenses will change because of that, right? So in 2029, we see that they will have negative cash flow, so they will need to find somewhere, take from their savings or maybe from their income, $752,000. And then every year, they will have expenses associated with this house equal $155,000 every year, right? And then when they sell the house in 2039, they will get $2.3 million in total. Okay, so now we see how income and expenses will change for this life event. And now we can go back and see on how it looks like in cash flow projections and net worth. And we see that at the end of the financial plan, the net worth of the family is expected to reach $14.4 million. Now, if we turn off this life event, right, and all expenses, income expenses associated with buying a winter house, that's going to be $20.6 million. That is $6 million difference for the family. So now they can actually understand what is the impact, financial impact of them buying that house. So they know that what they're getting a house which is worth $2 million. They will own it for 10 years, and then their net worth will be reduced by that by around $6 million at the end of the plan. Now they can make a decision and decide if it's worth for them, or maybe they will decide to spend this money on something else. Now let's take a look what happens when in details, right? Because on this chart we don't get too much information about what happens with taxes and other expenses when the family buys the house. So what we only see is that their income tax is going to increase to $433,000 from, let's see, to $90,000. So it's almost $140,000 that is added in taxes if they buy a house on that year. So let's take a look in more details what happens. So now we see the cash flow projection, and if we click on that, we can actually see the detailed breakdown of all income and expenses for the family in that year. And let's take a look what happens with the income tax, right? Like we have a tab taxes, and we see that there's an increase in taxes in that year. So federal income tax went up from $181,000 to $285,000 on the next year. And state tax went up from $60,000 to $106,000. And something that family needs to be prepared if they want to buy it. And on the right, we have a breakdown. So you can see that long-term capital gain tax is $81,000. And another tax which was added is net investment income tax. So what happens is that the family will need to take money from their savings. It's going to be taxable accounts. They will have some capital gains, and in order to cover these capital gains, they will need to pay the tax on the long-term capital gains. But because their AGI, or adjustable gross income tax, is over to $50,000, they are going to pay also net investment income tax on capital gains, which is $15,000. So if I turn off this event, you can see that long-term capital gain is zero and net investment income tax is also zero for the family. So it's something that they need to be prepared for. Another thing is, another interesting year is 2039. That's the year when they are going to sell the house. And we also see the spike in taxes, right? And it's, again, primarily driven by long-term capital gains and net investment income tax. It's because we are selling the house, there are gains. They expect that the gains will be $600,000 in that year, and these gains will be taxed. So the family will need to also to prepare for that. And they can also understand how it will affect their different accounts types. So this net worth tab, it shows us how taxable, tax deferred, and tax-free accounts will change over time. And what is also interesting on this chart is you can see that if I turn on and off this life event, that around 2053, there's a spike in taxes that happens. And it's going to be in 2054. Like, it's very interesting why it happens. Let's take a look on the net worth. So you see that around that year, we actually run out of money in taxable accounts. So we switch to use tax deferred accounts after that, which are taxed at a much higher rate than taxable. And that switch actually creates that spike because the family also around these years, the family is expected to have high expenses. So we have a spike here and have a coincidence. And it's something that we need to be prepared for. So I'm glad that we can see this issue early. Of course, it's pretty far forward, so we don't need to worry about that right now. But it's something that the family needs to be aware and adjust for if needed. All right, so we looked at all these different breakdowns, and we understood what this one financial decision like buying a house would mean for this family. Going back to the overview, we can definitely say that the family can afford this place and this house, and they still will be able to meet all their financial goals that they currently have, and they will have more money that they can pass to next generations. But that will come with some cost, right? Having owned that property, and that cost is around $6 million in difference in net worth at the end of the plan. And now the family can make a more informed decision and decide if it's a good idea for them to have this expense. I hope that you enjoyed this demo and find it useful. And you can try it yourself and build your own projection at nauma.ai. And I'll see you soon. Have a good day.